All right, let's dive in. Today, we're talking about one of the most powerful signals in all of trading, the pin bar. We're going to break down what it is, why it's such a game changer for a wild asset like gold, and this is the key, how to know when it's a golden opportunity versus a flat-out trap. You know, this quote right here, it just nails it. That one candle is exactly what we're talking about. It's more than just a pattern on a chart. It's like a footprint left behind after a huge battle between buyers and sellers, and it can literally signal a massive reversal before anyone else sees it coming. So here's our game plan. First, we'll cover the signal itself. Then we'll get into the anatomy of a pin bar. After that, we'll talk about the smart money trap. This is huge. Then we'll get into building a real high probability setup, how to execute your trade, and we'll finish up with what's probably the most important piece of the puzzle, your own psychology. Okay, let's kick things off with the basics. It really doesn't matter what your strategy is, support and resistance, order blocks, trend lines, you name it. The pin bar is kind of like a universal language in the market. It's a go-to for everyone, from retail traders like us to the big institutional players. And there's a very good reason for that. Let me put it this way. The pin bar is a fundamental tool. I mean, if you're trading forex, indices, and especially gold, and you're not paying attention to this candle, you are absolutely leaving money on the table. It's just a core piece you need to read what the market is telling you in real time. Right, let's get under the hood. To really use the pin bar, you have to understand the story it's telling you. So what does it actually look like, and what kind of fight in the market creates this very specific shape? Okay, so at its core, a pin bar has two main parts, a small real body, that's the thick part, and a really long tail or wick. And that long wick, that's where the whole story is. It shows that the market tried to go somewhere, tested a price, and then got rejected hard. So you've got two flavors here. A bullish pin bar has that long wick pointing down. It's telling you sellers tried to slam the price down, but buyers came in with overwhelming force. A bearish pin bar is just the opposite. The long wick is pointing up, showing that buyers ran out of steam and sellers took over. Now here's a key tip. Don't get too hung up on the color of the candle's body. The story is in that long, powerful wick. So let's make this real. Picture it. You're watching a gold chart during the London session. A candle opens. At first, wham, sellers take complete control, pushing the price way down. It looks like a huge, scary bearish candle. But then, you start to see buyers fighting back. The body of that candle starts to shrink. And then in one final push, the buyers just completely overwhelm the sellers, rocketing the price all the way back up to where it started. So when that candle finally closes, what are you left with? A tiny little body and this massive lower wick, the evidence of a battle that the sellers lost. That, right there, is the story of a bullish pin bar. Okay, now we get to the really important stuff. If pin bars are so easy to spot, why do so many traders get burned by them? Well, it's because most of the pin bars you see on a chart aren't signals, they're traps. And they are put there on purpose to fool you. The number one mistake traders make is they see the shape, they see that long wick, and they immediately think, oh, reversal. But they forget to ask the most important questions. A rejection of what exactly? Who is doing the rejecting? And why? So you're looking at the pattern, but you're totally missing the real story happening behind the scenes. And this slide explains exactly what's going on. That long wick you see, it's often the aftermath of something called a liquidity sweep. Think about it. Big banks need tons of orders to fill their giant positions. So what do? They engineer a quick price spike, push it right into an area where they know we, the retail traders, have all our stop losses. By triggering all those stops, they create a flood of orders, the liquidity they need to get in. And then they just push the price right back. That long wick, that's the footprint they leave behind. So check out this comparison. It's two sides of the same coin. The average retail trader sees a perfect-looking bearish pin bar right at a resistance level and thinks, yes, textbook reversal, I'm selling. But the smart money trader, the one who caused that pin bar, sees it as a successful liquidity operation. They needed to hunt all the stops above that level so they could load up on their own buy orders. See, the pin bar wasn't a signal for them to sell, it was the tool they used to buy. So the big question is, how do we stop falling for the trap and start trading with the smart money? The answer is, we have to be incredibly picky. We need to build a strong case for every single trade, looking for a bunch of factors that all line up and turn a simple pattern into a really high probability setup. Think of this slide right here as your checklist. A pin bar that just shows up in the middle of nowhere on your chart, that's just noise. Ignore it. but a pin bar that forms at a major support or resistance level? Okay, now that's interesting. If it also happens to be going in the same direction as the main daily trend, even better. And if you're trading gold and it happens during the London or New York sessions, now you've really got my attention. The goal is always confluence, having multiple reasons all screaming at you to take the trade. But let's go even deeper, because not all wicks are the same. You have to learn how to read the wick itself. How big is it? A wick that takes up more than, say, 70% of the entire candle, that signals a violent, powerful rejection. But a tiny little wick, that's weak. How did it form? Was it a fast, sharp spike, or did it slowly grind its way there? Speed equals power. And as you can see in this table, location and trend are just not negotiable. A beautiful-looking pin bar that's fighting against a super strong trend is still, at the end of the day, a bad bet. Okay, so you've done the work. You've found a high probability setup. The location is perfect, the wick is huge, and it's aligned with the trend. So now what? Let's get practical and talk about how to actually get into the trade and, even more importantly, how to manage your risk. So you basically have three main ways to get in. The most aggressive is what we call a market entry. You just hit the button the second that candle closes. A more conservative approach is the 50% retrace. You set a limit order halfway up the wick, hoping to get a much better price, which means your risk to reward is better. And finally, there's the on-stop entry, where you wait for the price to actually move past the pin bar, confirming there's momentum on your side before you hop in. Okay, lean in for this one, because I cannot say this loud enough. Wait for the candle to close. A pin bar that looks absolutely perfect can completely change in the last few minutes or even the last few seconds of its life and turn into a massive candle against you. Until that candle is officially closed, the signal simply does not exist. Jumping in early isn't trading, it's pure gambling. Patience is your best friend here. Look, a great trade idea is totally worthless if you don't have solid risk management. So rule number one, your stop loss always goes just past the tip of the pin bar's wick. That's the level that was clearly rejected. If price goes back there, your idea was wrong. Simple as that. Decide how much you're willing to risk before you even think about entering. And look, if a signal just looks a bit weak or the market is super choppy and messy, you gotta have the discipline to just sit back and do nothing. Wait for a better pitch. So we've covered the pattern, the strategy, the execution, but honestly, none of that stuff matters if you don't master the mental game. And for most people, this is the biggest hurdle. It's what separates the traders who struggle from the ones who are consistently profitable. Man, how many times have we all said this to ourselves? You see a pin bar and it looks like it was pulled straight out of a trading textbook. You jump in and the trade immediately goes against you. But because the setup looked so perfect, you just hang on, hoping, praying it'll turn around. This emotional attachment to a pattern is a killer. It's a psychological trap. You have to trade your plan, not your hopes. So this is the real gut check. This is the question you have to ask yourself every single time. Do you have the patience to actually wait for confirmation, to fight off that FOMO, that fear of missing out? And then once you're in the trade, do you have the discipline to actually trust your plan and let it work? Or are you going to get scared and mess with it? So if you only remember one thing from this entire explainer, please make it this. The pin bar itself is not the signal. Your analysis of the trend, your identification of key levels, that's what creates the trade idea. The pin bar is just the final piece of evidence. It's the confirmation, the trigger that tells you, okay, it might be time to act now. Context is absolutely everything. Now that you have this framework, I want you to go look at the charts. Do you find that the big, high-volume liquidity sweeps in gold give you cleaner signals during the London Open? Or do you prefer the momentum that kicks in during the New York session? Let us know what you find. We'd love to hear about your experience. Thanks for tuning in.